Hello and welcome to the devaluation of the yuan undertaken by China twice during this week has sent panic signals across the world. This move by China, which is already having impact on most major currencies of the world, including India, is causing a lot of concern. The Chinese move apparently to boost its exports and economy, however, had an immediate impact on India. The rupee, which has been getting weaker, however, hit its lowest this week, dropping by 136 paise or 2.13%. What does the devaluation of the yuan mean, and how will it impact India as well as other countries? What is the impact of the weakening of the Indian rupee? How should India and other countries face this challenge? We will discuss all this today with Ajay, former Secretary, Ministry of Industries and Commerce, Government of India; Renu, former staff member, RBI and IMF; Srikanth, Kondapalli, professor in Chinese Studies at the JNU, will be joining us soon; Paranjoy, Guha, Thakurta, senior journalist and economic analyst; and Pinaki, Chakraborty, professor at the National Institute of Public Finance and Policy. Welcome to all of you. Mr. Ajay, why is the rupee falling?
I would say rupee is not the only currency which has started falling. You've seen the major currencies of the world: dollar, the Japanese yen, Australian dollar, almost every currency, just euro. The fact of the matter is yuan is an important currency. More than the 4.6% decline, the devaluation which has taken place in the last 3 days. In fact, let me, Girish, just remind you that there have been three daily fixes.
Right.
1.9, 1.6,
Right.
1.1. So in all, we've seen 4.6% devaluation, or the daily fix as they call it. The Chinese economy is an extremely large economy, only second largest in the world, close on the heels of the United States, plus its own currency is now the Chinese are extremely keen that it so-called gets recognized. IMF's reserve assets, with which the special drawing rights, etc., are concerned. So most of the currencies in the world have been affected by these three moves, three daily fixes having been made. The Chinese, to my mind, have taken a call that more than the exports, we have to get our currency recognized. And all this is a move towards that end.
You think so? But does that fully explain why the rupee has fallen? Because rupee has been falling otherwise also. Before this devaluation happened,
very marginally. If you would see from 60 to 65 rupees, the devaluation occurred over 260 trading sessions. Today is 261st. Whereas earlier, when it had gone up to declined to 67 rupees in 2013, it had happened over just 28 sessions. So this was a gradual decline, and the decline was occurring for a lot of reasons earlier, including the fact that the promises of 10%, 9% rate of growth are not getting delivered, our exports were getting affected, the FDI was only marginally going up, etc. So I think the effect of this on the Indian currency is just about 2.1%, as you mentioned, 136 basis points. Or 136 paise. Which is less than the devaluation of the Chinese currency, which is 4.6%.
So
the impact can be considerable more in months to come.
We will come to the impact. Renu, would you agree with Ajay on this? Do you think that this is the reason why the Chinese have gone in for this kind of an evaluation to get their currency recognized?
It's as yet unsettled, and economists are debating on either side. That there's one opinion which says that the Chinese have done it because it follows, publishing release of very poor data and numerous policy efforts to boost growth, and it's not happening. Their latest GDP data was basically discounted by the markets. So there's one set of opinion which believes that the Chinese are doing it to make their exports competitive, and effectively they're joining the currency war. And there's another opinion which generally believes that the Chinese authorities are moving towards more introduction of greater influence of market forces upon the determination of the renminbi. And hence, that converges with the opinion that Mr. Dua said, which is for the inclusion of the renminbi in the SDR. Now, the thing is that if it is the latter, then obviously the credibility of the Chinese policy-making authorities or the Chinese central bank acquires a great deal of importance. And it is from that perspective, I would just highlight the fact that the press conference which was hurriedly called by the People's Bank of China, PBOC, yesterday, which was an attempt to reassure and assuage the uncertainty caused by this shock devaluation of the Chinese. And they said that it is aimed at introduction of greater deal of market forces. So it remains to be seen. If they build upon that, then definitely. Having said all this, I do think that it is not perhaps because to impart greater competitiveness to their exports, because the problems that China is having right now is a huge, enormous amount of corporate debt. And devaluation, as we know, if it's a permanent one, it's only going to inflate the value of that debt and make it more permanent.
Okay. Professor Srikanth Kondapalli, how would you look at it? Why has China done this? There are...
Hi. There are a few reasons why China had undertaken this devaluation. The first one, I think, is the urge to be part of the free market economy, which is what the 18-party Congress third plenum last year decided about the free market economy, breaking up of the state-owned enterprises and marketization. Can you hear me, Girish?
Yes, please continue.
No, it's gone.
No, I can hear you. Please continue.
So number one is, yes, number one is the 18-party Congress third plenum decision for furthering the privatization of assets, state-owned assets, number one. Number two is, as the other speakers have mentioned, the IMF is about to decide about the SDRs. And China has to show that it is implementing free market economy principles. We have seen that after the last month's Shanghai Stock Exchange and the Shenzhen Stock Exchange meltdown, there has been a lot of Chinese intervention at that level, where they have pumped in over $100 billion of the pension funds, very unusual move by China in resurrecting the stock exchange. Secondly, they have also asked the state-owned enterprises not to sell off their assets in the stock exchange. So this indicated that the privatization move or giving full play to the market is only a half-hearted one by China. So I think we will see more such devaluation attempts in the future. The third reason, I think, is because since 1980, when China started devaluing its currency, for instance, in 1980, the Chinese renminbi was 1.5 renminbi per US dollar. And that has been changed to roughly about 8.2, 8.3 renminbi for US dollar. And then subsequently in 2005, 2006, they have partly pegged on to the US dollar, and a series of measures were made. Once the current account balance is improved for China, they have been in a very comfortable position in the renminbi valuation. Today, actually, China has about 20 to 40% overvalued of its renminbi. So I think the effort today, this Tuesday, for 2% devaluation of the renminbi is in the direction of the whole set of things that have happened from 1980.
Okay.
As such, it is 20 to 40%, need to be devalued. So what we have seen is only a first bout of the kind of intervention by the Chinese.
Okay.
Yeah.
Chakraborty?
Yeah.
The impact of this. The impact of this on the Indian rupee. Ajay Dua says that, it's just 2.13%, but actually the impact will be much more than what the 136 paise indicates.
Yes.
Would you agree with that?
I certainly would agree with that point of Indian currency depreciating vis-a-vis Chinese currency. And if we talk about the depreciation, our depreciation is definitely much less than what has been done in a big bang manner by China. And given the fact that we have got huge volume of trade relationship with China, definitely it would have an impact on our domestic production and consumption. So Chinese good flooding into Indian market might be a possibility which can definitely have major impact on our own growth, because the fact here is that our growth is largely domestic demand driven, unlike China, which is actually has a large export orientation towards growth. We have to see what happens to our currency in that context, because and also we have to go back to the fact that China is not devaluing currency today. China has artificially kept its currency low for quite some time. And it has happened in 2009 also, when US economy was in doldrums. Now you have a stronger US economy. And the kind of reports that are coming in, they are saying US will not be that affected because of the stronger growth signs that US is showing. So Chinese impact will be felt in the developing and emerging markets much more, because their exposure to Chinese goods and services are much more than the rest of the world, than US. So in such a situation, I think the situation is definitely grim. But at the same time, I would also say that there are a couple of, at least one aspect to start with, is the global economic environment as far as the crude prices are concerned, because our import basket is heavily dependent on crude import and oil. It's almost our 80% of the oil comes, all of us know, as import. And since the rupee is depreciating, on top of that, if we had a very high crude oil prices, I think the panic would have been much more than what it is today and what we are discussing today. So I think that comfort level is there. I think we should utilize that. If this goes out of hand, and a lot of exchange rate management issues has to come in here, and if this goes out of hand, and at the same time, as we are expecting that things will unfold more and more as far as the currency devaluation is concerned, and further devaluation, and if at the same time the crude prices hardens, I think we'll have a serious problem of subsidy bill, getting into the higher fiscal deficit, high inflation, and then definitely growth will be a serious question.
Paranjoy, would you agree with that?
I do agree with most of what has been said by all the speakers. I want to add a few points. What Renu Kohli earlier pointed out, there are of course two views on what has happened. One view is that, look, this was an overdue adjustment. The Chinese government had controlled its economy and its financial sector very, very closely. In any case, the Western countries were claiming that the Chinese yuan or the renminbi had been already undervalued to boost exports, and now that has been further undervalued. Having said that, many would agree, and I do believe in certain respects as economic phenomena go, this is as significant, perhaps more significant than the crisis in Greece or the expected increase in the interest rates of the US Federal Reserve. Now, why do I say this? As Mr. Dua pointed out, in terms of nominal exchange rates, the Chinese economy is the second largest in the world. In terms of purchasing power parity, it's already overtaken the US. It is the biggest economy in the world. Now, what happens is and second point is that this process of these, daily fixes, I don't think it's over. I do believe at least in this first round of devaluation, it'll...
Srikanth also doesn't think it's over.
Absolutely. I think there's going to be further devaluation. I believe at least a minimum of 5% will happen in this lot. Now, coming specifically to India, and more importantly, what is happening in China is like a trigger effect, and what Renu described as a possible currency war that we'll have to be accustomed to. Let's look at the figures. I'll put exact figures. in the last financial year, 2014-15, imports from China to India went up by almost 20%.
Right.
From about $60 billion. Our exports actually came down from
Exactly.
15 to 12. As a result of which our trade deficit in the last few years shot up by more than 1/3, and it's currently in the region of 48 billion for almost $50 billion. Now, having said that,
this is expected to go up further, the balance of trade.
No. Let's again look at these figures. I'll give you the exact figures. Only 4% of India's exports are going to China, but 13% of our imports are from China. Already we are seeing signs of protectionism. Recently, in 2 rounds, you've had customs duties being increased on steel products because Indian steel makers are worried about dumping, worried about predatory pricing. They are saying the Chinese are going to sell below cost of production and we'll be finished. And the government has reacted already. So now what is happening, if one looks ahead, there's certainly going to be greater volatility in all currencies, including the Indian currencies. And I am on the pessimistic side, given the slowdown in Europe and the kind of exports that India could increase to get out of this, it won't work. So at one level, yes, we are cushioned because of the falling oil prices, which account for 1/3 of our total imports. So even though the rupee has devalued and 65 rupees, but we are cushioned to some extent because international oil prices are down. But exports are not likely to go up as well, and may not benefit from the weakening of the Indian currency.
Absolutely.
No, India is actually going through a low inflation period. And today also it has gone on
Negative
further.
inflation,
the
WPI,
wholesale price
4%.
inflation has gone down further. No, but you think that the impact of this, the yuan, the rupee going down, and hit on the imports, the import bill will go up. So you think the inflation, should we start seeing inflation going up again?
I think the logical conclusion would be what you were saying. If our imports are largely inelastic. If
because
they
of the
become
70% of our
absolutely,
oil coming,
oil, machinery, gold, virtually inelastic, as you see. If the cost of those goes up, obviously it's going to be passed down both to WPI as well as the CPI, and much more in CPI, which is, in fact, that could slow down the response of the Reserve Bank to the rates. People were expecting till 3 days ago.
In fact, even yesterday, people were saying that low inflation, so bring down the rates. But that may not.
This may not happen. Second, and that's my fear, our exports are going to, if rupee becomes cheaper, our exports should increase. That's a normal. But I'm afraid that's not going to happen this time, even despite this so-called impact of the change in currency, because the competition from the Chinese goods is going to increase the worldwide.
Absolutely.
Whether it's in the US or in Europe.
Or in Asia, in the other parts of Asia.
So 40% of our exports are with the US and EU, EU being the larger of the two. We are going to suffer there. We are also going to have a problem of greater Chinese imports.
Exactly.
Even without what was just referred to by Paranjoy, that Chinese, Koreans, and we've seen Indian industry being hit by cheap imports, steel.
Right.
And this morning I was watching a TV debate on how the tire prices in India are going to be hit because the Chinese are able to export 20 to 25% cheaper tires. So the adverse impact of
it's going to be felt all round.
And over time, and we might see that we need to do something much more to make our Make in India campaign effective and not get derailed by this external factor.
Okay. Renu?
If I can just add
1 second.
1 minute.
I'll come to you.
Just 2 lines to what...
I'll come to you, Renu, 1 second. Paranjoy wants to.
Just add to what Mr. Dua has said. India and China compete with each other on exports of like gems and jewelry, on textiles, on garments. Now, all these things, we have to keep in mind. Indian exports have been declining continuously for the last 7 months. That's the point.
Yes, Renu.
Yeah, just to add to this discussion and the points made by the co-panelists, we should expect China has very much chosen the time for shifting to a more market determined or market based exchange rate, because all the forces would point towards more of a downward adjustment in the renminbi, because let's look at it, Chinese economy is weakening, A, B, its trade surpluses are shrinking, and C, it's been seeing a lot of capital outflow flows since last September, which is more than 6 months. So all these forces point in the direction of a weaker renminbi. But at the same time, because it's wanting to establish its credibility, it's going to intervene in both directions, and therefore there was a bit of, sales to actually contain the depreciation pressures. The second point is that China accounts for a huge amount, more than 50, almost half of the world's demand for industrial raw materials and other non-food agriculturals. Now that's going to, the prices are definitely going to, because there's a huge demand shock there. And obviously it's pulling down prices. It is what is being discussed as called as global deflation. And one part of that is explaining the oil prices from the demand side. There is, of course, another issue of supply forces in the oil. So both those, this global deflation, what is entering into India, will be imported by way of much lower input prices, which is going to continue. At the same time, the rupee is getting pulled down for the reasons mentioned by some of the others on this panel. A lot of uncertainty, and the fact that there is always such adjustments are always triggering a lot of portfolio rebalancing, and also the fact that your exports are going to get hit. So what you're going to be seeing by way of your currency depreciation upon domestic inflation and other feedback pass-through effects, to an extent is going to be offset by lower input prices. And indeed, we have been seeing these effects or the interplay of these forces in the last few months. If you've seen the WPI, which reflects your tradable input prices, it's in prolonged contraction mode. So, we cannot really, I would reserve judgment about that. We are definitely going to see high oil prices. No, oil actually has been sinking to $40 to $42 per barrel range. B, whether we will see high inflation, I doubt it, because I would still keep the jury out on that, because there are offsetting
you will
factors
keep the jury out, okay.
as well at play.
Okay. Srikanth, how serious is China? You were saying that they are trying to, get this recognition, and they want the IMF to make Yuan a global reserve currency. You think that is where they're heading towards, and you're saying that they will go in for further devaluation. So, what is the motive?
I think there is also the other motive of the Silk Road projects and AIIB, New Development Bank of the BRICS. These are also part of the compulsions for China in this round. In addition to the U.S. Federal Reserve idea of kind of reshaping the interest rates and so on and so forth, which is due now. But I think in terms of impact of the current devaluation, I would see this mainly in the short term. I don't think there will be a major impact on India. Number one is because the Indian exports and imports from China is only it is still second largest trading partner. But when you compare with the entire trade basket of India, China's component will be about 7 to 8%. So I do not think that this will have a major impact on the overall Indian economy.
Professor, I'll give you the exact figures.
Srikanth, Paranjoy wants to intervene.
Professor, it's 13% of India's imports come from China, and roughly 4% of India's total exports go to China. I'm just giving you the official figures of the Commerce Ministry for the last financial year.
Yeah, please continue, Srikanth. No, what they're trying to say is that,
I was trying to say that
60 over 520. So that's 14.
I was trying to say that the whole proportion of $70 billion of imports and exports between India and China is in comparison to $600-700 billion of the overall trade. this is only a small portion.
Okay.
Roughly 7 to 8% of the Indian external sector.
So you think
Number
that
two,
so
most important thing is India had not entered into any swap arrangements with China so far, currency swap arrangements. To that extent, since there is the RBI still in discussions with China on the swap arrangements, and nothing really concrete has come out of it, fortunately, I think we will be saved at least in the short term.
Okay. Chakraborty, the impact, we'll come to what is it that India needs to do now to ensure that, we don't get into trouble. Some of you are saying that it may not have a short-term impact, but certainly it will have a long-term impact.
I think fundamentally there are two issues. What are the structural strength of Indian economy? The structural strength of Indian economy is that our growth is largely domestic demand driven. That is first. And what is the structural weakness of Indian economy? Our import is largely inelastic.
Right.
So under this situation, if we look at the devaluation in China, what can happen? First thing is that Chinese export will flood Indian market and things which Professor from JNU is talking about, that it's not going to have a major impact. I don't know. Because the consumption, the export basket is very important. It is not the aggregate volume of trade. So that is the first issue. So if the basket, where we are also competitive with them vis-a-vis China, because
there is no way in which we can curtail the imports from China.
It's quite difficult. It's quite difficult.
As far as the government is concerned.
Yes. And in that context, I think it would depend how situation evolves. It's very difficult to say yes or no. So it's not a binary situation. But one major problem that is happening in Indian economy is the issue of continuous decline in the demand. So effective demand in the country has declined despite we are talking about high growth rate. Those estimates are coming. We are going to grow at about 8% rate. And if we believe that we are going to grow at an 8% rate, and we have always been talking that we are going to grow more than China, fastest growing in the economy, but our rural demand has continuously declined. So it is irrespective of the fact what happens to China or to the rest of the world. So I think it is very important if our structural strength of the economy is in domestic growth, so we must revive rural demand.
Okay. Ajay?
I think...
What is it that the government of India can do, the RBI can do, to ensure that, we don't get hurt as badly as we think we would?
Even if it sounds somewhat drastic, I think we would have to become increasingly protectionist. We would need to protect our nascent industry.
Is it possible to be protectionist in the present order?
Absolutely.
World order, WTO.
Sir,
the obligations to the WTO.
We do have ranges within which we can operate. Whether it's the WTO or our FTAs, etc., we've done that in steel, and I still expect that another 2.5% we could go up to. In fact, if you would recall, the finance minister in his budget itself had talked of 15% protection to our basic material
protectionist.
industry. 12.5%.
We become more protectionist. What else?
At least temporarily, in order to face this. Second, we would need to also then look at the disadvantages of the external environment being compensated if the government fiscal position permits, now that the bill on subsidies, etc., is less, getting back to some degree of concessions, so-called SOPs, for the industries, particularly the automobile, engineering industries, etc., which are largely labor-intensive and are assets. And Reserve Bank of India would need to do a little more. One, it would need to now start selling dollars in order to ensure that the price it doesn't go up. It would need to also start giving the oil companies open, which it has done in the past, a special window from where they borrow rather than the open market trade. And finally, if we can, and Reserve Bank can play a major role in it, is deferring our payment of certain import bills by asking for longer payment periods.
I'm sorry, I completely run out of time. But I'm sure all of you also have some more suggestions to it, but we'll wait and watch, and we'll certainly come back and revisit this entire issue again. Thanks to all my guests. Please keep watching. We'll come back with another issue in the big picture same time on Monday. Meanwhile, have a great weekend and a very happy Independence Day too.